You've probably heard it. It's this sound that calls to the ambitious, the risk takers, the dreamers. It's the hum of a market that never sleeps, promising fortunes in the blink of an eye. That's the crypto siren's song. And you know what? It is almost impossible to ignore. Let's really dig into why it's so powerful and what it does to our minds. I mean, the appeal is obvious, right? It's this thrilling, fast-paced world where unbelievable gains feel like they're just one click away. It promises more than just a return on investment. It promises a story, an emotional roller coaster that very few other assets can even come close to matching. We spend so much of our time analyzing charts, reading the news, looking at the technicals. But what if we've been looking in completely the wrong place? What if the real code we need to crack is our own psychological programming? That's what we're going to get into. So, what makes cryptos so incredibly captivating? It's not just the tech. It's the speed. The whole market moves at a pace that just perfectly feeds our desire for instant gratification. It makes that illusion of quick, easy wealth feel incredibly, dangerously real. You know, at the heart of all these wild price swings, it really just boils down to two of the most primal human emotions. Greed is what pulls us in during those massive bull runs, whispering about life-changing money. And then there's fear. Fear is what pushes us out during the downturns, screaming about catastrophic losses. This emotional tug of war, well, that's what creates the insane volatility we see every single day. Okay, so here's where it gets really interesting. It's how our minds are basically hardwired to get caught in this cycle. There are these specific psychological traps that we fall into, a lot of the time without even realizing it. So let's pop the hood on the engine that's driving these decisions.
First up, we've got herding. This is our deep-seated instinct to just follow the crowd. When we see a huge group of people making the same move, our brain just kind of tells us, hey, that must be the right thing to do. And so we start to dismiss our own research, our own gut feelings, and we just follow the herd.
And the bandwagon effect, well, that's what gives herding its incredible momentum. It's like a social pressure cooker. You see your friends, you see influencers, you see headlines all celebrating these huge gains. The pressure to jump in becomes, well, it becomes immense, and it often completely overpowers any kind of rational thought. And what's the fuel for this whole fire? You already know it. It's FOMO, the fear of missing out. This is that deep, gnawing anxiety that you're going to be the one left behind while everyone else gets rich. It is such a powerful emotional trigger that it literally short-circuits our rational brain and leads us straight to impulsive and, yeah, often regrettable decisions.
So what does this whole psychological engine actually look like in action? Let's take a look at the two absolute extremes of a market cycle. This is where these forces are most visible and most dangerous.
During a bull run, everything is green. Herding behavior is absolutely everywhere. Confidence is through the roof. People see prices just soaring and they jump in. Not because of the fundamentals, but simply because the numbers are going up. It feels like a massive party where everyone is winning and absolutely no one wants it to end. But when the market turns, that exact same herding instinct kicks into reverse. Fear takes the wheel. And now the crowd is sprinting for the exits. People start panic selling, not because their original reason for investing has changed, but just because everyone else is selling. The very same groupthink that created the euphoria now creates the crash. And look, this isn't just theory. We've all seen this play out. Just think back to the NFT boom in 2022. Thousands of people jumped in, totally driven by hype and these crazy stories of massive profits. It was a classic textbook case of FOMO-fueled herding. And when that bubble burst, the crash was absolutely devastating, leaving countless people with really, really heavy losses. So beyond just herding, our brains have these other, well, they're like built-in shortcuts or biases that can totally blind us. They are systematic errors in our thinking that cause us to stray from rational judgment, especially when we're under pressure. Let's just touch on a few big ones. First, there's confirmation bias. That's our natural tendency to only look for information that confirms what we already believe about an investment. Then there's overconfidence bias, which is that dangerous feeling that you somehow have a special gift for predicting the market. Next is anchoring, where we get mentally stuck on a specific price, like what we first paid, and it just clouds our judgment about when to sell. And finally, there's loss aversion. Think about it. The pain of losing $100 feels way worse than the joy of gaining $100, right? That feeling causes us to hold on to losing bets for way, way too long. Okay, so we've laid out all the psychological traps. The real question is, how do we avoid them? Well, it really all comes down to a choice between two very different paths: chasing speed or embracing discipline. On one side, you have flipping active trading. Let's be honest, it often feels more like gambling. You're chasing quick profits, you're riding these intense emotional waves, and you're facing higher risks and usually higher tax rates. Then on the other side, you have hodling, or long-term holding. This is much more like traditional investing. It's built on a belief in the long-term value of an asset, and that generally leads to smoother volatility, a lot less stress, and often more favorable tax treatment. So here's the crucial point. There is no single right answer. The best strategy is the one that actually fits you. You have to ask yourself, can you stomach a 30% drop overnight without hitting the panic button? Do you have the time to be glued to the markets? Answering those questions honestly, that's the real first step toward a sound strategy.
And that's really what it all boils down to. The most successful investors, they aren't just market wizards. They're experts on themselves. They know their biases, they know their emotional triggers, and they know their own tolerance for risk. They build a plan around their own psychology, not just around the charts.
So, as we wrap this up, just remember this one thing. The crypto market will always sing its siren song of quick riches, but true, sustainable wealth, it isn't built on reacting to every little market swing. It's built on a plan, it's built on patience, and on self-awareness. Wealth isn't speed, it's discipline.